This is the CRE Weekly Digest by Lightbox, a data and technology firm for the commercial real estate market. I'm Martha Kocher with Manus Clancy, Head of Data Strategy, and Diane Crocker, Research Director. For the week of July 29th to August 2nd, investors digested the expected Fed decision of no change in the benchmark interest rate, but markets quickly pivoted to concerns that the economy is cooling way too fast. Initial unemployment claims were higher than expected. Manufacturing fell to an 8-month low, and of course, today, the monthly unemployment rate rose to 4.3% in stocks, and treasuries reacted immediately, with treasuries hitting the lowest since December of 23. Manus, Fed Chair Powell did tee up the possibility of a rate cut in September, but that doesn't seem to be soothing investors in the wake of this week's data.
Well, it's funny. We cut our podcast on Friday mornings Eastern time, so a lot of times we see breaking data, whether it's jobs reports or PCE or other things coming in shortly before we record. And today's jobs report had me thinking about football, of all things. The NFL football season started last night with the first preseason game. And I remember last year with the Jets that they worked all summer long. They were talking about going to the Super Bowl, and Aaron Rodgers gets hurt after 3 plays, and it's time to tear up the playbook. Today, we had our narrative going after all the data we saw this week. And then the jobs report comes out today, and it's time to tear up the narrative. That was my reaction today. The jobs report is quite market moving this morning. The number itself for July was well below expectations. Unemployment picked up to 4.3%. Wage growth, if I read it correctly, was at its lowest level since March of 2021. That sent the markets reeling. They have since recovered a little bit of their footing. At one point, the NASDAQ, I think, was down 400 or 500 points. The Dow was down 500 points. That has pared some of those losses. And the Treasury curve collapsed today. So the reaction was very severe. It comes on the heels of a very volatile month. We've now seen 2 days in the last 3 weeks where the NASDAQ sold off 3%. Some of the real AI darlings are now down 20 to 40% from their peaks. Over the last 2 days, if today's trend continues, we'll see 2 more days where the NASDAQ is down 2% or more. So a very volatile couple of weeks, and not only on the economic side, but certainly also on the political and geopolitical side as well. If there's 2 silver linings to take about these last 2 weeks for the CRE market, and we'll talk a little bit more about this later. Silver lining number 1 is falling treasury yields should support asset prices. That's the positive. And historically, CRE reacted very unfavorably to high volatility. We've seen high volatility over the last 2 weeks, yet the CRE market continues to soldier on. People are lending, sales are taking place. And at this point, the CRE market is setting aside all of this volatility and soldiering on.
You know, it's interesting, Manus. Certainly there's been a flurry of news in this normally quiet summer and a lot to keep up with. One thing that I did this week, and Martha, you'll find this interesting too, I dug out our 2024 predictions report, which we released in mid-January. And on the Treasury rate front, our prediction was that Treasury rates would stabilize at 3.5 to 4%, heralding revitalization by year end. And perspective is we wrote that report in late December. And at that time in early November, the 10-year Treasury was at 4.8, which was its highest level in 16 years. So our prediction was that we'd get to 3.5 to 4. So it's been interesting to watch the data this month. I think, how close were we to that prediction? How'd we do?
Well, we're getting there. We're certainly well under 4 now with the 10-year. Will we get to 3.5%? Do we want to get to 3.5%?
Right.
The benefit is if you get to 3.5%, cap rates fall in theory, and property values shore up. It gets easier for borrowers with cuspy properties to muddle through and get refinancing. That's the upside of a 3.5% Treasury for the 10-year. The downside is it probably comes part and parcel with a recession, or at least some bumpiness in the U.S. economy. So I guess you're careful for what you wish for.
Yeah.
With that 3.5% prediction. I'd like your thoughts on another thing. You've said before that the election in the U.S. has the potential to keep people on the sidelines. Let me take it in a different direction in terms of keeping people on the sidelines. So you're a buyer. You've been sitting on the sidelines. You've seen high cap rates for a long time. You've been thinking, I'm holding on to my dry powder because things could get worse. Now we're seeing Treasury yields plummeting, which normally would harken in a tightening of cap rates for stabilized properties that are performing. Do you think buyers that have been hesitant thus far are now turning around and saying, I better get in before cap rates fall even further? The panic goes from one direction to another. What are your thoughts on that?
I think that force is at play, and it might even overshadow any kind of traditional tapping of the brakes that we might see in another presidential election year. What's interesting about this second half and where we sit right now is that we're having that confluence of market factors that you just mentioned at the same time that we're having this really divisive presidential election. And, who's going to win with those two forces? I do think that you can't dismiss that kind of FOMO sense that those with their own capital have. I think every deal that we talk about on this pod makes others who have capital who maybe haven't pulled the trigger yet eager to jump in. And I don't know, if I were a betting man, I would probably say that will win over any kind of adverse impact on transactions that we might otherwise see in a presidential election year.
I agree 100% with that. I think that, and I feel like I've been an outlier in this in my conversations, at cocktail parties or conferences or so forth. I've been saying that when the floodgates open, they're going to open wide, that people are not going to want to be the person that raised all this money and is stuck with low cap rate investments after cap rates had been elevated for 2 years or more. Whether this is the inflection point now or not, I think remains to be seen. It feels to me like July was another uptick in transactions. We saw a real flurry of big number 9-digit transactions late in the month. So my feeling is, even though a lot of people think that it's an L-shaped recovery, right? We've fallen off the cliff and we're going to stay low for a long period of time. I certainly don't think it's V-shaped or even U-shaped, but I do think that with rates falling, if cap rates compress, that we will see a real uptick in activity in the coming months because people do not want to be left behind.
Yeah, I totally agree. Picture them like standing on a pier in Manhattan waiting for the ferry. They don't want to be still on the pier as the ferry pulls away, So I think you might be right. And I'll say, July just ended on Wednesday. So I'm gathering our final numbers there and we'll be able to talk about the July monthly CRE activity index next week and see how it's shaking up.
Yeah, I think that FOMO will be a big part of how the market behaves in the coming months. I hope I'm right. Because this market has endured, especially for sales brokers, leasing brokers, a difficult 24 months. It's been very, very challenging. We'd like to see this rebound. But I should add one caveat. I kind of hinted at it before, and that caveat is this piling in, I think, is limited to stable cash flow producing assets, right? I don't think the piling in translates into offices or other things that have noise or are stories or repositioning. I think that will continue to be slow. What I'm really talking about are Class A apartments, industrial with strong cash flow, retail with long leases, that type of stuff. I don't think that FOMO and that gravitational pull extends to some of these deeply dented property types.
Agreed. And I think also in metros that are kind of like the up and coming stars, investors are going to be out there thinking, okay, Nashville's hot now, Charlotte's hot, so's Austin, but what's the next one? Where can I come in and get a decent property at a low price and hope for an ROI down the road? So we've just released a trio of snapshot reports that do provide a forecast. And Diane, it's interesting. You went back and looked at how we forecast the beginning of this year. What are you saying about the rest of the year, and have you rethought it given this week's data? The short answer, Martha, is yes. It's very difficult doing forecasts now because of that flurry of activity that you just talked about, Manus. But what we did this week was release a trio of our mid-year market snapshot reports that cover environmental due diligence, capital markets, and appraisal in turn. And I think the common theme across all three of those is there is this guarded sense of optimism in the market right now that, you talked about optimism, Manus. There's definitely a sense of caution as well. I think people are hopeful for the second half. I don't think it's just wishful thinking. And I think the reason is because rates haven't budged, of course, certainly not to the extent that people expected them to back in January. Rates haven't budged, but capital is starting to. And deals are happening, as we've talked about in the pod, that we really didn't see last year or even in the first quarter of this year. So I feel like that's really fueling a sense of momentum returning to the market. And so the forecast for all three of those segment reports for the next 2 quarters
reflects a couple things. One is that once rates begin to come down, which seems pretty certain will happen in September, our data should reflect higher levels of transactions, more liquidity in the market, greater momentum, certainly than we saw in the first half. It also reflects the fact that distress is rearing its head this summer. You've been, seeing it and hearing it in the stories we're highlighting in this pod. So, as the market deals with the volume of maturing loans and distress, the market will need the support of appraisers, of environmental consultants doing environmental site assessments. And that work will happen whether it's on fire sales or loan workouts or foreclosures or just the good old traditional transactions that Manus just mentioned. So our forecast reflects those factors that are driving activity, good and bad. We did account for headwinds like the geopolitical uncertainty, the election, which we just mentioned, and the fact that the fourth quarter is typically a seasonally slow quarter. So those all exert some downward pressure. Final answer, flat to moderate growth. I think the appraisal segment is more sensitive and more dependent on, I should say, rates coming down. So property listings, they're going to benefit from transactions, especially if rates come down, but even if they don't. And then on the environmental side, they'll be supporting work on both distress as well as traditional transactions.
My hot take, and I'm not the forecaster or the economist that Diane is by any measure, is that we've gone through a long stretch where CRE has underperformed other asset classes in a big way, right? Stocks are up enormously. It's been a great couple of years for equity returns. People's 401ks are just surging, and CRE has been kind of the laggard of all asset classes, really, commercial real estate at least. And now I see the second half of the year where the entire picture reverts somewhat to the mean. I do think that the slowing of the economy means we probably see more pain in equities between now and the end of the year. And I do think that CRE is the beneficiary. Does that mean we're popping corks as of December 31st? No, but I do feel like we no longer feel like, we are the forgotten asset class, the unloved asset class over the next couple of months. I do think that we feel better about the entire industry over the next couple of months.
Office pain continues to get ink and news. We have a number of stories that highlight that fact. Manus, let's walk through some of those.
Yes, this is the other side of the coin, so to speak, of the benefits that we're talking about today with lower treasury yields and the likelihood that people can tap capital lower. The other side of the coin is that the office story continues to be a really negative one. It's interesting. I was speaking to a banker this week, a guy I've known for a long time, a chief credit officer who's been through many cycles. He's seen the market go through the 90s and 2008 and so forth. And his reaction is similar to what I was expecting, but it may be contrary to what others may think. I've been saying for a long time that multifamily, retail, industrial, hotel are not really issues. For multifamily, it's really only those that have taken out floating rate debt. And for office, the problems are real and severe. And this person's reaction was, all of that is spot on. He's seeing no problems in his portfolio across any of the four major sections other than office. But he does say that office, even though the pain has been severe, that we may not even be near the bottom. And I think that that's very telling. When I've been seeing these 70 and 80% discount prices, my feeling has been we have to be near a bottom, right? We're seeing people sign NDAs and we're seeing properties sell. He was not so sure. So that was an interesting perspective. Going through the office pain, some of the things that we saw this week, the big headline, which was a misleading headline, I would say, was the fact that a Midtown office sold at $8.5 million via auction. This property in particular is 135 West 50th Street. It sold via 10X through a JLL listing. The property is a 920,000 square foot office in Midtown Manhattan. And certainly the $8.5 million sale price, the $9 a square foot, shocking. The New York Times came out and said that this is a 97% discount to where it last traded. That's quite misleading. UBS, when they bought the property, bought both the land and the property itself, the building itself. A couple of years later, they sold off the land for a very high price, close to $300 million. So they recovered about 90% of what they paid for the land and the office a couple years into the trade. So this $9 million has to be added to whatever they got when they sold the ground lease to Safehold. But nonetheless, this particular story got a lot of traction on Twitter. People were panicking. The market is now a 97% discounted market. You really have to go beneath the covers there to get the true story. If you want a more accurate reading of the math here, you can go to Elizabeth Cryan's story in The Real Deal. She she talks about the ground lease and everything else. So that was the headline, created a lot of noise in the market, a lot of pain, but I would urge you to get behind the story. Out in San Francisco, we have a couple of stories. Sarah Clearman of the San Francisco Business Journal reported that LBA is going to acquire its second office in downtown San Francisco. In this particular case, it is buying a $92 million loan on 255 California Street from teachers. They're buying that loan for a reported $55 million purchase price. So paying there about 60 cents on the dollar to acquire that asset. And that price is about a third of what the property sold for in 2019. So a 66% discount to where this property was valued at 5 years ago. Also in San Francisco, from Laura Waxman of the San Francisco Chronicle, BH is acquiring a 120,000 square foot office at 989 Market Street. The price there, $13.5 million. The price is 80% off the $61 million that ABS Real Estate Investment paid for the property about 10 years ago. A couple of other stories in Coral Gables. This is from Lydia Dinkova of The Real Deal. It looks like the Columbus Center may be headed back to the lender via deed in lieu foreclosure, something to keep our eyes on. And Emma Whalen of The Real Deal reports that the Feel organization is going to give up the ghost on a River North property in Chicago. This is at 730 North Franklin Street. Why did this capture my attention? Feel only jumped in to this trade about a year ago. They bought a note on the property, coming in thinking they could reposition the property very quickly, make a profit. And now they're giving up, they're throwing in the towel only a year into that trade. So, those headlines weighed on the market this week, and I imagine there'll be plenty more to come in the months ahead.
What's interesting, Manus, about the office deals that you just mentioned is both the one on West 50th Street and one of the ones in San Francisco cited that the buildings were only like 35% occupied. Some were built in the 60s. The one in New York looked like a pretty old, tired space. So I think it'll be interesting to see what the buyers' plans are, to renovate and upgrade and maybe add the golf simulators and yoga rooms and other amenities that we talked about in last week's podcast.
We'll have to have on the podcast one of these distressed office buyers at some point, because my feeling is I'd rather have that building right now that's 80% vacant and have my options open and pay a deeply discounted price than paying that same price for a 60% occupied building where the duration of the leases is 2 years and you're biting your nails for 2 years trying to figure out, is this tenant going to renew, not renew? When can I start repositioning this building and so forth? So at some point, we will bring in one of these players to discuss with us, how they see this market currently and how they see it evolving going forward.
That's a great idea.
Let's turn to a Lightbox data dive. In terms of non-disclosure agreements, Lightbox tracks the weighted averages as a way to gauge the level of interest by investors for a particular asset class. So we look at that, we report on it, and we have some interesting data that shows what's happening in the different asset class types.
Yeah, Martha, NDA requests are interesting for us to track because, it's really a sign when people see a listing, they want more information. They want to see the documents behind the listing to see if a deal's worth exploring. So first off, I want to give kudos to Marissa Winsky, our marketing manager on the broker and capital markets side, who did a really cool comparison of NDAs by asset class for the property listings in our RCM platform in Q2. And one of the things we talked about on this podcast last week was that the average number of NDAs per listing across all asset classes in Q2 was 105. But when you look at it for specific classes, you got a sense of where investors have the most interest. And in that regard, multifamily ranked first with an average of 140, and then retail was 113. So both of those were above that 105 average. And then one other thing I want to mention is, just for fun, every quarter we look for that one listing that gets the highest number of NDAs. And you're going to love this, Manus. In Q2, it was for a listing on an office building in Texas that got requests for more than 700 NDAs. Now, the average for office in Q2 was 70. That was up from 63 the prior quarter. So 700 NDAs is more than 10 times the national average for office. So there's more evidence that the entire office sector is not struggling, and investors are certainly interested in exploring opportunities.
I'm intrigued. We'll have to
I
talk
knew you would be.
offline. I'm interested to learn which property this is. And, certainly Texas has been a magnet for corporate relocations for a long time. And most recently, Tesla, Elon Musk has been talking about moving that franchise from San Francisco to Texas. So I guess if you're going to see something like that, Texas would be the place. There's been a real gravitational pull to that area and Florida as well for the last several years.
Right. Turning to leasing, looking across the country, national office leasing activity has increased 15% quarter over quarter, according to JLL, and it's hit the highest level since the first quarter of 2020. So we talked a little bit about office having a bifurcated situation, and Class A high amenity office space seems to be the space that people want to go to. I saw in the Cousins Property earnings call, the CEO, Colin Connolly, had said that the broader office recovery certainly appears to be underway, but especially in the Class A office segment.
Well, that's certainly true. We've seen some nice leases recently. Ares and Blackstone in Midtown Manhattan expanding their footprints. Class A in major metropolitan areas has generally seen its asking rates hold up quite well. That story's been around, and it continues, and that's a positive for the market. I think the unicorn this month, and I'm going to run through some of this data very quickly in a moment, was just how many leases we saw signed really coming out of left field. And in many cases, the leases being signed were not those Class A's. They were Class B's, maybe even B minuses. I'm not easily surprised. Like I'm one of these people that I feel like I've seen everything. And to see the litany of big leases that were signed this month, I thought was both surprising and quite satisfying, right? We know that leasing has been anemic for a long time. To see so many big numbers being put out this month was really encouraging. And with that, I'll run through some of them. This first one, Paul Schwendelson of the Philadelphia Business Journal, the Defender Association renewed nearly 120,000 square feet at the Packard Building on Sansom Street in City Center, Philadelphia. With that renewal comes an increase in square footage by about 20,000 square feet. The property itself, a 400,000 square foot building owned by Method. So look for that story. From Nick Trombola of Commercial Observer, the National Institution of Health has signed a 10-year renewal for 125,000 square feet at 6555 Rock Spring Drive. It's also known as the Atrium at Rock Spring Park. The landlord there is MC Real Estate. That deal was represented by Merrill Trumbull, Brent Prosner, Jay Lee, and Will Rupp at Lincoln Property, and another big one there. Moving on, Bechtel, the engineering and construction firm, signed 2 big leases this month. One in West Houston for 110,000 square feet. That comes from Real Estate Business Online. And then from Commercial Observer, again, Nick Trombola, Bechtel renewed and expanded its lease at Boston Properties 1 Reston Overlook in Reston, Virginia. The firm Bechtel signed for 300,000 square feet across 11 floors at that property. The new lease is an uptick from the 260,000 square feet that they had in that area. From Claudio Tiganescu of Commercial Property Executive, Cooper and Scully has renewed 50,000 square feet in downtown Dallas. Kansas City Business Journal, Thomas Freestad, State Street signed a new lease. They're moving from WeWork space to the Crown Center in Kansas City, taking up 30,000 square feet. Again, that's an uptick from what they had in Atlanta. Colliers renewed 40,000 square feet at Promenade Tower. That comes from BizNow's Jared Schenke. In New Jersey, Joshua Bird of Real Estate New Jersey. Day Pitney is moving to Parsippany, taking 55,000 square feet off of the, if I'm not mistaken, is off of the Jersey Turnpike, that building. And in St. Pete, Bankers Financial is moving downtown St. Pete with 50,000 square feet at the Duke Energy Building at 299 First Avenue North. That has a little bit of negativity as Bankers Financial is downsizing from 100,000 square feet in St. Petersburg Gateway area. So that's 9 stories right there of leases, renewals, and so forth that really seem to come out of left field in July.
Yeah, you know which one really jumped out at me, Manus, was the one about Bechtel. And the reason is because I gave a mid-year market update this week to the construction lending risk management group. And, construction starts, I think we're down by like 25% last year. So they're really struggling, but nothing speaks to optimism like new big office leases. So the fact that Bechtel is going down that road, I think, is an indication that they're gearing up for longer term growth. And one of the things we talked about during the session this week was, even though construction starts are way down, commercial real estate is entering what I think will be a really exciting period of reinvention. And so I wouldn't be surprised if constructions begin to increase next year and in 2026 as all this tired space gets either redeveloped or renovated to match the shifting sands in commercial real estate. And I think that Bechtel story just speaks to the fact that you've got this leading construction firm that's really positioning itself to grow.
It's an interesting thing. You talk about optimism, and I agree. There's no bigger vote of confidence in this market that when everybody is clutching their pearls about office space, for somebody to come out and take 300,000 square feet in one market and another 120,000 square feet in another, to speak of optimism. And it reminds me of my golf game, right? I don't know why this is. I don't feel like this way in life in general. Like, I walk a fine line that things could go bad or things could go well in any morning when I wake up. I kind of play it right down the middle. But for whatever reason, my incredible optimism every day is when I go out on the golf course, even though I've almost never break 90, right? That today is the day I'm going to shoot 76. It's hard to explain where that comes from. Like, there's no basis in reality. There's no reason for me to think this way. And yet, when I put that tee in the ground, I put that ball up, I think, I'm going to shoot 76 and there's going to be a hole in one. I don't know. It's the big lease equivalent that just raced through my mind.
It's that one hole that you have that goes well. That's what happens.
My nightmare scenario is someday I do get a hole in one, but it comes on a day where I don't break 100, even with the hole in one. And I have to show people my scorecard. It gets framed and people look at me like, God, you're just terrible. And you just hit one lucky shot, didn't you?
What do they say? Even a broken clock is right twice a day.
Well, there you go.
So turning to who's buying, you saw that KKR had their earnings call this past week. It was interesting. Obviously, their story was a positive one. The revenue in the first 6 months doubled year over year. But I thought some of the commentary underneath their earnings were interesting. They said, so far, 2024 feels like it could be a sweet spot year where values are attractive and activity levels are high. This is in contrast to last year when values were attractive, but transaction volumes were muted. So you talk about optimism. They said this year, we not only have an open market, we've got pent up supply of deals that haven't gotten done.
Well, not only are they talking the talk, they are walking the walk. They have put so much money out in the market these last few months, buying a big multifamily portfolio for $2.1 billion. That was last month. This month, they spent $240 million on a industrial portfolio in Houston. Before that, they bought, or this was just yesterday, they and Dallin Management paid $240 million for the Paxton, which is a big multifamily apartment complex in Brooklyn. So this was not idle talk on KKR's point. I think somewhere in the headlines this week, there was some incredible number that they had put out to work this year. My recollection is it's something like $20 billion that they've already spent. I could be wildly off on that, but it was eye-popping for me when I saw how much money they had put to work.
It was $8 billion just in the last quarter on real estate buys.
That's walking the walk. They are out there, and I've said this on prior podcasts that there's smart money and there's dumb money. And I put KKR firmly in the camp of smart money. And if they're out there deploying capital, it's because they think that they're seeing 12 and 15 and 18 and 20% returns, over a 3 to 5 year window. And do you want to be betting on the side of KKR or do you want to be betting against them? I guess for people that are on the fence, maybe that's the question to ask.
So we saw another month of a flurry, I don't know, a bunch of
a McFlurry?
Yeah, there we go. Of 9-digit
McFlurry.
sale. That's good on a day like today where it's going to be 97 degrees here in New York. So we saw a lot of 9-digit sales this past month.
Yes, this comes in the category of tearing up the playbook again, because I gave Martha and Diane the list of things we saw just this month. When I gave them the list yesterday, the list was stuck at 29 sales that we noticed that were 9-digit and up, so 100 million or higher. Since then, we've seen another 6 in the last 2 days. So I'll run through some of the ones that just caught my attention. In Seattle, the Skyglass property, which is a really cool looking building at 757 Thomas Street, sold 2 days ago for $175,520,000 per unit. The buyer there, Goldman Sachs. In Darien, Connecticut, I guess this is probably near you, Diane. The Avalon Darien sold for $120 million. The buyer there, AEW, picking the property up for $635K per unit. In Hoffman Estates, Illinois, the reserve at Hoffman Estates sold for $102 million. This is $160K per unit. The interesting data point there, only 2% below where this property sold in 2018. The buyer there, FPA, who has been picking up properties hand over fist for the last couple months. And then one more in New York to go along with the Paxton, which we talked about a few moments ago. This came out just yesterday, late afternoon. 20 Exchange Place, an apartment complex in Lower Manhattan, sold for $370 million. That equates to $480K per unit. The property is huge, almost 800 units. The buyer there is the Dermott Company, the seller DTH Capital, and that story comes from Commercial Observer. So that is in addition to several other big properties that we talked about before in Jersey City, Boston, San Diego, Plantation, Florida, Delray Beach, Walnut Creek. This gives you a sense, Beverly Hills, Washington, D.C., Chicago, of properties and locations that were sold for north of $100 million. So what's the takeaway there? The takeaway there is if your day is dominated by that headline that New York office sold for 97% off, you could be missing some good opportunities. And the fact that the market is starting to turn slowly but surely in many places and across many different property type segments.
And the takeaway is that I may need to bump up my near-term forecast a little bit.
Well, I hope it doesn't sound like I'm shilling for the market. I do feel like we are at an inflection point with lower rates, with lending spreads staying stable, with liquidity picking up. I do believe it. It's not just idle talk on my part. I do believe that no downturn lasts forever, although the office one may seem that way. 2 years is the normal length for a downturn of CRE markets. And now we're at about 27 months. It's time.
Right. Agreed. And we'll see what the July numbers say. We'll have the final ones for next week's podcast.
I do want to correct the record on something. A listener pointed this out to me yesterday via a message on Twitter. This is Donut Shorts, by the way. I always believe that you have to follow both the Bulls and the Bears on Twitter to get a real picture of which way the wind is blowing. He pointed out that I got something wrong last week. I said that the REIT had cut their dividend, but it was a different Blackstone entity, a different REIT under the same family, which had cut its dividend. And I wish I could say that I misspoke, but no, I got it wrong. My research was off last week and Donut Shorts corrected the record. So I wanted to make sure that I did get that factually correct.
Manus, I know you're not a Patriots or Bucks fan, but maybe you're still a Tom Brady fan with the news of the quarterback moving his family office to a larger office space in the Miami area. So that's good news. They have apparently a wellness spa, and that includes craniosacral therapy. I have to be careful how I say that. It's not easy to say. And a sound dome for meditative experiences. So good on Tom for doing that in the Miami area.
I'm trying to let this sink in a little bit. Let me start by saying, now the football season has started, it's time for my NFL prediction for the year. And for the 52nd consecutive year, I am going to pick the Giants to win the Super Bowl because I do that every summer, regardless of what their prospects are. But as to Tom Brady, all I could think about is if I were to come into either our New York or Irvine offices and I saw analysts with one of these like kazoo-like headsets on, I don't know, I'd be a little freaked out. I'd be walking around with a drumstick, beating them on the head, kind of saying, what's going on here? It just seems too close to a tinfoil hat than something I'd want to see in the office. That's my hot take. I wasn't really prepared for that question, but that's my immediate takeaway.
My hot take was sign me up. I'll do it. Sounds good to me.
Thanks to our producer, Hannah Tebow. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments, corrections, or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go Giants.